Hey everyone, welcome back to Perspicium. Today we're going to talk about VIX. More specifically, what would have happened if you bought when VIX was elevated? Would you have bought the S&P 500 on the days when the world felt like ending, October 2008 or March 2020? Those were days when VIX, the market's fear gauge, was above 80. And historically, buying around those kind of fear spikes has often led to strong returns over the next few months. So the question isn't, does buying panic work? The real question is, can we quantify whether fear actually improves expected returns and remove luck and noise from the equation? Today, we will test that using data from 1993 to 2025. First, a quick reset. The VIX measures expected volatility in the S&P 500 over the next 30 days. And instead of picking a magic number, we are going to break volatility into regimes. Calm, under 15, normal, 15 to 20, elevated, 20 to 25, stress, 25 to 35, crisis, anything above 35. And here's the most important reality check. Most of the time, we are not in crisis. Crisis is rare, only around 4% of the time. Now, before we even talk returns, I want you to see regimes in the real world. This is S&P 500 price over time, and the background shading shows which VIX regime we were in. You will notice something. Crisis regimes cluster around major market events. They don't happen randomly. And they also don't last that long. That's going to matter in a minute. Now, the test. For every single day, we label the VIX regime, then we measure what S&P 500 did after that day, 1 month later, 3 months later, and 6 months later. Let's start with the 3-month horizon, because it's the cleanest for the regime behavior. Here's what most people assume. If volatility is elevated, forward returns should be higher. But the data is more nuanced. When VIX is 20 to 25 or elevated, S&P 500 average 3-month returns are only about 1.4%. That is actually worse than the calm markets. So this is the first big takeaway. Not every dip is equal. Not every fear is opportunity. But what happens when the fear becomes real? When VIX moves into stress, 25 to 35, S&P 5's average 3-month forward return jumps to about 4.8%. And in crisis, about 35, it's about 7.5% over the next 3 months. And 6 months out, it's even stronger. So yes, fear can raise expected returns, but only when we are talking about true stress, not mild volatility. Let's add NASDAQ to the picture. Same regime labeling, same forward return test. The pattern is the same, but magnitude is bigger. In crisis regimes, NASDAQ's average forward return is around 12% over 3 months and over 24% over 6 months. So tech tends to crash harder, but rebounds even faster and harder than S&P 500. But the logic doesn't change. The edge shows up in real stress regimes, not in mild fear or volatility. This chart makes the point clean. Across regimes, NASDAQ tends to have more upside in stress and crisis, but it also tends to be more sensitive to volatility overall. So if you're trading fear rebounds, you're implicitly choosing a risk profile, and if timed right, NASDAQ can have a much bigger payoff. Here's where most people jump to the wrong conclusion. They think that they can only invest when VIX is elevated. So we tested that. The rule is simple. If VIX is about 25, you invest in S&P 500. If it's not, then you are in cash. Over 1993 to 2025, buy and hold compounds at about 10.7% per year. And the only invest in stress rule compounds at about 3.9% per year. And the reason is simple. It's only invested about 18% of the time. So you enter during panic, but you exit before compounding phase really takes over. To be fair, the VIX timing rule does reduce risk. Here are the drawdowns. Buy and hold saw a drawdown north of 50%. The VIX timing strategy has smaller drawdowns because you're out a lot, but you pay that by missing the long, calm expansion. So it isn't free lunch. You trade less upside for less risk. Better approach is not all in or all out. It's sizing. That's what volatility targeting does. When volatility rises, exposure comes down. When volatility falls, exposure rises. And in the backtest, vol targeting gives you much better compounding than VIX in an out rule and better drawdown control than buy and hold. This is the institutional lesson. use regimes to adapt exposure, not to disappear from the markets. And if you want to learn more about volatility targeting, I have a video in my YouTube channel, link in the description. One last point, and this is important. Even high VIX isn't one thing. This heat map breaks the VIX into buckets and shows average forward returns across horizons. You will notice some higher buckets are amazing, some are noisy. Returns don't increase smoothly with VIX. At extremes, outcomes widen. That's exactly why sizing beats timing. These regimes are not linear, and it's not healthy to extrapolate what might happen. So, here's the conclusion. Elevated volatility does matter, but not all elevated regimes are equal. Moderate fear is often just noise. Real stress is where premiums expand. And the edge isn't predicting fear, it's having a process that adjusts exposure when regime changes. Volatility isn't the enemy, it's the price of opportunity. Thanks for watching, and make sure to like and subscribe if you enjoyed the content. And if you want to run these models for yourself, all the tools are at theperspicium.com. Link below. Stay sharp, and I'll see you in the next one.